Thank you so much for staying. I know how hard it is, and I know how important and how dry the topic is. So let's make the next 45 minutes worthwhile, okay? I know those are trying to be on diet. It's a great way to stay in here, okay? So we're gonna make it a bit live. So this is probably the only topic throughout the agenda talking about ESG. Now there are lots of, I guess, excitement, fatigue, confusion, frustration, you name it out there. But this topic, no matter what name you give it, it's not going to go away for a long, long time. So please, let's try to add some value, mainly for you guys. And I'm very lucky today because the people on the panel today have taught me a lot. So hopefully some of their experience can be valuable for you guys as well. Now, we plan to take live questions in the final 10 minutes, but if there are some comments, some live questions you want to chip in, please, let's have a good time, okay? So you see the title already? So the discussion is gonna be two parts. We'll look at some of the challenges, some of the existing risks, how some of my panelists have overcome those challenges. Then we do a bit of forward looking in terms of where we're going on the journey, what are our clients are thinking, but more importantly is how can technology be helpful in terms of helping your clients and your firm on this very important journey. So first, let me very quickly explaining who are with me today. And if you want to know them more, they will be available at lunch. And then, of course, their detailed bio is available for you to zoom into as well on the website. Now, to my very right, that's Adam Webb, representing ICBC Standard Bank. Is the Chief Operating Officer, has done a lot of work on risk. To his left, to my right, is Johnny. Johnny is Managing Director, Global Head of Risk and Sustainable Finance at First Derivative. Johnny has tons of experience on the sell side and buy side. So again, will be very interesting. To my left, I have a good friend, Michelle. Michelle, representing Wells Fargo. She's a director and focusing currently heavily on the EU taxonomy in terms of strategy and how does it link in with their clients. Last but not least, very grateful to have Lucette Ivanov, and she heads up the newly formed, incredibly important systematic fixed income business at Fidelity International. So without further ado, Johnny, you think I give you compliments without challenging you? You're gonna start first, okay. So we think about ESG related challenges. We often hear that ESG risk can be material, it will impact on pricing and valuation, but how does it really link in with your day-to-day job? And how does it link in with your board or your senior management in terms of their expectations?
Okay, I'll open with trying to make this exciting. I know of a CEO who said we're going to reduce the carbon emissions of our business by 50%. And suddenly a fight broke out in the room between the CEO and the head of trading because they just committed the head of trading to something they had no idea how they were going to do. So when we talk about the data and the solutions for all of this, generally it starts with policy and governance, and then suddenly it trickles down to the people who are trying to solve the problem. And one of the things we've tried to frame around all of this is simply to use ESG like an umbrella term. We actually refer to it as sustainable finance. And the reason we do that, it captures all of these vagaries, ESG, climate risk, biodiversity. Because it's all in flux, whatever is thrown in the melting pot, we can capture it under this trend of sustainable finance. It also means we don't put it in a single silo. So a policy at board level on risk appetite suddenly flows down to what does that mean for climate risk appetite, or governance risk appetite, or the securities or the commercial lending we're going to do to different industry sectors. So you can actually depersonalize it. You can remove this question about whether or not it's a right thing for investing, etc., morality of it. So you try and reduce it to something quite quantitative so that you can take an objective and then say, to achieve that objective, what type of solutions, technology, data, and mathematical methods one needs. So the way that we've completely reduced this problem is to make it simpler and simpler. And we said, well, if we can't take any type of policy and translate it to what does it mean for the way we run the business, and then ultimately how do we value the products in our business, it's rather meaningless. So we've gone right to the core of what is the financial system about. It's about solvency, and that means properly valuing assets and liabilities. Now, that's really well codified in banking. We've got pillar 1, 2, and 3. That same type of pillar structure in different guises exists whether or not you're in asset management, insurance, or any other type of service provision to those industries. So if one reduces it to things such as the solvency of the organization, you can start to look at it from a pure risk perspective and evaluation perspective. Now, I accept that's a very narrow thing. That denudes the whole problem of interpretation, of regulation, of behavioral practices in a business. What is your policy on who you're going to lend to and why? Those can be much more subjective. But we decided to start with something that was more tangible. And that was driven really by the regulations that were coming through. And we saw the first mandatory regulation as being yet another cost to the financial services industry. And it was carbon reporting for banking. Now, that doesn't exist, carbon disclosure. So in Europe, it's led the way with EBA Pillar 3. And in many respects, that looks just like credit risk aggregation, BCBS 239, for those familiar with it. It also means the banking industry is the only one mandated to report on carbon emissions for the products and securities and instruments that they issue. The moment you sell a bond from a bank to an asset manager, that carbon reporting disappears in the system. So it's actually a flawed system. We've made representations to the European Commission to correct this. It also raises a question of why would the banks only want this information? Because there's a perfect triangulation between the three major players in financial services. Banks lend money to businesses that have to get insurance, and those businesses are then invested in by asset managers. There's now a convergence of interests around data and processes and disclosure between those three major verticals of the financial services that's never existed before. And one of the ways of bringing them together is actually approaching a risk modeling and the revaluation of the liabilities and assets for those industries.
Thank you so much, Johnny. You can see that he deserves a solo act here. Thank you for setting the scene. It's very important that we're thinking about asset pricing and valuation, especially at individual asset class level now. You talk very well about the connectivity linking with regulation, especially for banks. Michelle, I think it's a perfect segue to you. I'm sure those will feel the same. The regulations, just catching up with the names of regulations, you're going to win the prize, okay? So, Michelle, over to you. The EU taxonomy, it's kind of progressing quite a while, lots of requirements. How does it impact on your bank and your clients?
That's a really good question, and I want to tag on to what Johnny said about you wanted to make it simple. The taxonomy doesn't make things simple, unfortunately, and that's one of the big regulatory challenges that we have. Like when you think about just purely from the taxonomy perspective, it is extremely complex, and the EU Commission has already acknowledged it as such, right? And so the complexity and lack of data that we have right now are big things that we, as a bank, we need to think about. However, we should not give up, right? Because we need to think of this, take a step back. The reason for this wave of regulatory change on sustainability is to fulfill the European Commission's, the European Union's pledge to the Paris Agreement. So it's really about setting down foundations for a long-term shift in the market landscape. And therefore, when we think about what we need to do, it's going to be a multi-decade effort. We will also need to be quite patient. I know it's human nature to have a quick fix. We're not going to have a quick fix, so we need to acknowledge a sequencing timeline. Although the taxonomy regulation came in first, And we're starting to see initial information about taxonomy eligible and aligned activities. We do also need to wait for what's known as the ASUS, the European Sustainability Reporting Standards, ASUS, sorry, another acronym. They will come into place very soon, and we will start to see more information. So that data issue will start to eventually get solved, right? But what do we need to do today? We need to invest in our data and technology infrastructure. We need to also set up a strategic roadmap to evolve our data maturity model. And it's not too late to start now if you haven't.
Perfect. And I think it's very important. I think Michelle making very good points. Regulation, reporting, whatever the things that we have to do, but they must fit into the overall strategic agenda that creating long-term value for shareholders, employees, and ultimately, to the business and community. So just on that regulation part, I think nobody envies your job, Adam. I'm thinking about the Chinese stakeholder, the African stakeholders. How do you manage those multiple cross-region, cross-culture, cross-business approach stakeholder requirements?
Yeah, thanks. With great difficulty, I think is the answer. But it's probably worth breaking it down between internal and external challenges. So if we think about internal, these can be generic across firms, or they could be idiosyncratic to a firm, and it may depend, as you say, on your geographical footprint, who your regulators are, who your shareholders are, what your product set is, all things like that. But if we look at the internal challenges, or some of the ones that certainly we've faced and probably others in the banking industry can relate to, prioritization. A lot of you're always going to get differing views as to whether climate change, ESG, however you want to refer to this, is a priority for a firm, how much resourcing you dedicate it to, how much budget you dedicate to it. That's probably one of the bigger challenges to overcome, especially when you have these differing opinions and shareholders in different locations, and you're regulated by someone completely different from your shareholders, etc. The resourcing aspect as well. So I think if we can agree that, we're talking about the rise of ESG here. So this is a relatively newish topic, I'd say, for the banking industry. And then, how do you upskill your staff quickly and efficiently to be able to absorb what's required and build it into your business? Does that mean going out and hiring specialists, which are not easy to find, especially if you're a smaller firm, because they tend to be cherry picked by the larger firms? Then when you've done that, embedding. So how do you embed these considerations into your systems, your processes, your controls, etc.? How do you identify those? How do you know that you're picking the right ones? How do you know you're doing it in the right way when there isn't a lot of industry guidance or best practice? Because this is a relatively new topic, as I said earlier. And technology. How do you stay ahead and be clear that you've got the right data and systems in place to be able to quantify your risks whilst also taking into account ESG considerations or climate-related considerations? I doubt anyone's there fully, but for a smaller firm, it's even more challenging. Then when you think externally, regulators, as you say. So if we agree that UK, EU are probably first movers in this space, but then they're looking at it slightly different ways. So the PRA came first, they talked about climate change. EU came along, it was climate and environmental risks. We're also regulated by the MAS in Singapore, they're looking at environmental risk. We've got offices in the US, not really much firm regulation there. So it's all different competing interests necessarily, which doesn't then make your job when you operate cross-border that easier. Activism's another one. So, there's a lot of pressure now on firms across the financial sector to go further and faster, which, has risks to business models and that sort of thing. Firms are being pushed, particularly by NGOs, to go harder when it comes to climate change and decarbonisation. Shareholders may be pulling you one way towards that, but other shareholders may be pulling you another way. Increasing litigation risk, very, very challenging as well to get ahead of. Greenwashing as well. This is a real theme now, that how firms can keep on top of that whilst not then, succumbing to litigation risk. And finally, I think policy direction. So from governments themselves. So regulators may do one thing, but governments may do another. And, recently the UK put out its updated green finance strategy, and it was very ambiguous. There wasn't a lot of guidance as to exactly when things are happening. It was very, we will explore, we will consult. Doesn't really help you as a firm trying to manage competing interests. So taxonomies as well, that's been mentioned. The EU taxonomy differs from, say, the Chinese taxonomy. EU has recently put natural gas in there as a sustainable investment. It's been taken out of the Chinese taxonomy. The UK doesn't even have a taxonomy yet. So, how do you know you're doing a piece of business that works in one jurisdiction, doesn't work in another? And very, very challenging to get around.
Well, look, did you feel the joy, the joy and the potential little bit pain, just a little bit for people like Adam? But thank you for keeping going, because I think it's very important that, we continue sharing our thoughts to the public consultation in terms of further interpretation. When there's a policy, when there's a regulation guidelines, this is something I think each one of us need to work out internally what that means. And then be very realistic about what can be done and what cannot be done today, but what could be done, in the medium long term. And the other thing I would pick up what Adam said is that let's think about the technology solutions that fits into the overarching strategic value creation or pain reduction. So rather than thinking, oh, I can do X, Y, Z, because it may not have the right support if we're only pitching, or if you guys only pitching one level of the solution. So I'll come back to you on the technologies, some of the technologies. So Lucette, now you obviously, look after the investors, which are incredibly important to help, transition for the decarbonization economy. But your approach is very much like outcome-driven approach. So how does the ESG input, whether it's a data or other type of input, that translate into value creation for you, for your clients, and ultimately, how does it fit into the portfolio construction?
Yes, thank you for the stupendous question. So obviously, as the Fidelity investment, we have 3 big pillars. As Adam described, obviously, there's the challenge of embracing ESG worldwide, where we have over 100 entities as Fidelity. And then there is the regulatory that directly apply to our client, insurance company, pension plan, and other regulated business worldwide, which have all not only their own regulation, but also their tilt on their preferences regarding ESG. And then internally, obviously, we are attempting to position the portfolio the best way, not only in terms of obviously making our planet more sustainable in the long run, but also leveraging already all the technology and data point that we have around available, sometime at high fees, sometime more freely. But also we are gathering our own set of data, and our credit and equity research itself and our ESG notation are part of this growing asset that we have in terms of data that in the future we can utilize not only for our clients, not only to drive our client solution, but potentially also to sell back to company and other players in the market. So this is quite a wide array, and that's why we have come with a mixed model in terms of how we integrate the data and the data set, where the core power of the platform is powered by Fidelity technology. And obviously it's embracing as much our client regulatory framework and their preferences on an ongoing basis, which obviously tend to change also going forward and as their business develop. And then we are embracing both internal and external data sets. Some of them quite quantitative, some of them also very qualitative, which has its challenge in an ESG future, which want to be quite black and white in terms of are you performing the right test, are you having the right decarbonization trajectory, what is the scenario and alignment for your various portfolio. So combining internal, external, all kind of size and fit for data set. Also, some of the data set don't cover all the company we need to research. Some of the data set would only cover a small time frame and don't have historical data that we can test our strategy on. So quite a large challenge, but a challenge that we will resolve with technology.
Thank you so much. I think it's you make some really good points about quantitative, qualitative data, but data itself does not mean much unless the managers then get translated, analyze it in terms of either risk management or return or alpha generation. But in parallel, as Lucette mentioned, that they also help clients doing reporting. So again, there's so many things that asset managers are doing, and they are, developing and learning along the way. So just building on the data point, I know, Johnny, you're very passionate about data, but we all know that this is very different to the traditional type of data that we often use. The ESG or climate or whatever you call, is very much a forward-looking approach. But so far, everything that we have gathered, which is often voluntary basis anyway, are very much based on historic data. So how do you balance that forward with what we have, but also do you do scenario analysis, and how does it fit into your overall thinking?
Okay. So the very first thing about data is there's no shortage of people to sell you data.
And they're very expensive as well.
The biggest problem with data is that people are buying data when they haven't asked the question of what am I trying to achieve, and how does that translate into the data we actually need. To give you a very simple example, if we're trying to revalue bonds with no historical data, say it was just on carbon emissions, the question correctly framed is, how can I change the number of basis points I use on a discount curve according to carbon to revalue the bond? Now that gives me a framework to say what type of data I should be looking for and what type of methods I might be trying to use to translate a ton of carbon into a number of basis points. Now that sounds quite abstract, but if you look at the bond market today as an example, when it started, the bond market was an over-the-counter market, and it was very much a bilateral negotiation between borrowers and investors. So you get to a point where there's a feedback loop from the real market to the academic theory and the actual data analysis. So you reverse, first you start with a data guess and an approximation. You go to the market, they test it to see if somebody will buy or sell at those prices, and if not, you tweak it, and if the model doesn't work, you tweak the model. So it's actually an iterative process. And what I would say is this whole revaluation process we're going through now, it is predicated on solvency. I coined the term the big green short. We all know what the big short was, 2008. The big green short is the same type of concept. If you get asset and liabilities mispriced, at some point you fall off a cliff. Some people will make a ton of money, some people will lose a ton of money. So the question arises, what do you do when you don't have the data to answer the question you've correctly framed? Well, you can only fall back on one of two things. You can either do guesswork or you can do mathematical proxies, and then you take either of them to the market to test them. So that is exactly the core work that most academics are focused on now. And I would say that we've got really well-developed risk frameworks for pricing assets. We've got methodologies for valuing companies and all other sorts of things. We do not today even have an agreed taxonomy on how to revalue an asset through a climate stress test. And if you look at the principles of those models, there are many different approaches to integrate all of these variabilities in the world. But they're ostensibly not financial models, they're meteorological models. So how do we translate meteorological models into mathematical models? That's one of the biggest problems for economics. The second is, how do you start to build a time series of data which is historically robust, when all you've really got is a simulated set of data to start testing it? Well, it's like everything. You have to have the elapse of time. But equally, we have one unique thing this time around. If you look at history and how we got to very robust financial data today, it's actually taken a cycle of many hundreds of years. 500 years ago was the very first book ever written and published on double entry bookkeeping in Venice by a chap called Luca Pacioli. That actually is still the basis upon which we do financial analysis and valuation of assets today. However, you take the banking system in Basel, since 1988, when the first minimum capital standards came into banking, the mathematical complexity that's come into the models in Basel IV is just off the scale. It's in the hundreds. Basel V, I believe, will focus on climate risk, and it will spill over into everything. Now, when that comes, we will start to use all of the previous lessons of proxy data, simulated data, to guess at how the market will react to price changes, and then we will test it in the market. That's how I think it will work.
Basel V, did you hear that? Anyway, so thank you, Johnny. I think it's very important that based on what you shared with us, is that I think all of us need to, I haven't finished, don't worry, I'll come back to you, but it feels like I'm doing a summary, but it's all of us need to think about this topic with substance, because it's much more than making commitment, policy. Lots of the companies, financial institutions included, are confused with their existing CSR, corporate social responsibility approach. That's why they struggle to see how does it translate into business. And in the case of investors and the financial institutions, is how does it really translate into a risk management and ultimately differentiate themselves in terms of making the right investment and having the right pricing arranged. So hopefully I come back to you again, but no Basel VI this time. But Adam, please. I know that lots of people today in the room or outside are technology providers. So what are your experience in terms of the key technologies that have been helpful? And what do you think needs to happen so for them to be more helpful, going forward?
The problem is there's too many options out there. And, I get emails every day from a different firm saying, yeah, we do this, we do that, we're amazing. And great, I'll move on, because there's just so many, and it's difficult to then decide where we should go next. Should we look into this? Should we, explore this one further? Because there is just so many out there, which is not a bad thing, of course. Choice is good, but to narrow down what's relevant is challenging. So I think we have made some investments in technology to assist us here. It's mostly been around our onboarding and our client due diligence. So we have invested in some systems there to help us capture that ESG instant approach from a counterparty perspective. We've also looked at solutions to help us with trying to map and model our physical climate risk. But, these are really early stages stuff, and we don't even know if these are the right tools for us yet, so it will take time to understand that, etc. But I think for me, and for not just probably the banking sector, but the asset management sector as well, is disclosures. That's the real risk that I see coming for all of us, and greenwashing and trying to avoid that. And the incoming ISSB standards are going to be a lot more granular, a lot more data-driven, a lot more scenario analysis-driven, a lot more quantification required than, for instance, TCFD does. It's there's only 11 recommendations with TCFD. ISSB has dozens. So being able to comply with that. Again, when you're thinking about it from different jurisdictions as well, having the right data to do that is going to be challenging significantly. So I think solutions that can help us deliver on that will be of use to everyone, I think. And also, thinking about other things like Scope 3 reporting. We at the moment don't report our Scope 3 emissions, but there's enormous focus on that coming from regulators and governments, because that is where, particularly for a financial firm, most of your emissions sit. So particularly in that investment section of it. So there's 15 categories alone in that. And looking at the emissions of your suppliers and how does that play in. We've got thousands of suppliers. We don't have the ability to throw loads and loads of headcount at this. So we need technology solutions that can help do that for us, gather that data, and do the calculations for us. And the same goes for our financed emissions, because the PCAF standards, etc., are very focused at the moment on loans or bonds and debt investments. But we have a much more significant derivative book because we're more of a markets business. So how do we calculate our Scope 3 on that? Do we do it? These are huge things. So I think things that can help us do that will be the sort of things we'd be looking for. And primarily, these things need to be scalable and they need to be affordable. This is the thing, we haven't got millions and millions to throw at this. I go to one, oh, we're 150 grand. I go there, it's 120 grand. You know, these things need. We live in a free market economy. That's great. But you know, these things, to make them sustainable, need to be affordable, not just for the bigger firms, but for the smaller firms as well. So scalability, able to track across different jurisdictions, bringing those requirements in, and something that is affordable is the sort of thing we would be looking for.
Thank you so much for sharing. I would love to be in the same budget meeting with Adam. It's going to be very fun. So if I think about it, really, I think he made, again, a very interesting point about, you know, the scale, affordability, and functionality. But also we live in a very challenging geopolitical and economic environment, business. I doubt they will have more budget. If there's a budget, most likely allocated to these areas. Again, how this budget should be utilized and, you know, and really making the money of those investments is a big question, I think, for all of us to think together. You know, it's not going to be the same answer. But moving to you, Michelle, you think it's nearly finished, right? It's nearly finished, but you are very passionate about innovation. Now, think about the work so far on reporting, disclosure, regulation, everything. Everyone feels like, again, I say feels like playing catch up. But how do, for example, banks differentiate themselves and then actually capture this, I guess, you know, joyful journey and to be a potential leader in this space?
It's a very joyful journey indeed. And I think if you track back to what I said at the beginning about having a strategic roadmap, obviously, you know, like everyone else, we don't have millions and millions of budget to spend. We need to have that strategic roadmap, to have that discipline about what do we need. And in this context, I think actually you can think of regulatory change as a framework to think about where the opportunities really are and how do you innovate. And I'm going to take it's a big example, but one example you can think about takeaway. The EU Sustainable Finance Framework has 3 pillars. So when you think about where you're going to position yourself, how do you differentiate? Think about the first pillar, disclosures. How are you going to get ahead of the game by making sure you have the disclosure information you need to generate what you need as a bank and how you advise clients? Second, taxonomy pillar. It will pay off if you take the time to master the taxonomy, understand the criteria, all the processes, because you will be able to use that as a foundation for the third pillar, which I will say is actually the most interesting. It's known as your tools and instruments pillar. When you have managed to master both disclosures and foundations, I'm going to accept that's going to take time. That's when banks like us, you know, everyone else in the room, when you're thinking about how are you going to bring products to market that will make sense, that will be profitable, and will be win-win all round, right? One example, I'm going to talk about look out for the EU Green Bond Standard. We've already had provisional agreement on that. We're expecting to see, we're being told that it will be taken a vote at the end of the year. How are you going to then be able to help your clients market a green bond? That's going to be taxonomy aligned, right? That's when you have to have that. You say you have the mastery of the taxonomy criteria, you have the information, and then you can be you can be the bank of choice. And that's how you think about it. It's not just risk, it's an opportunity as well as we progress on our sustainable finance transition journey.
Yeah. I think that combination between the upside opportunity and the managing the downside risk management is a given now. I think for a while it's all about managing risk, quite rightly. I think now on the back of it, all players in these markets need to think about the opportunity side for themselves. So thank you so much for sharing. Last but not least, Lisette. So when we think about investors, when we think about asset managers, you know, the word ESG is now at a very interesting juncture on the journey. You know, you got lots of frustrations. Probably the word is overly used, you know, overly clarified or under clarified. But how does value generation or creation for your clients mean for you? You know, and also what you think we are going next on this?
Yes, thanks. I totally think that obviously the clients are driving the innovation, and we need to respond with strategic solution to the innovation. Now, there is a lot of confusion because we have sustainable solution all around the planet, which are based on the minimum requirement potentially to carry such a terminology. And then we have a whole scope of product which are more looking at engagement, transition, and then we have the solution which are already more transition and are looking at only the best of the best with very high ESG credential. And obviously, these are not all equal under the sun because they don't necessarily help for future generation to transform the way we know the planet is going to need our help. So the first thing I would say is obviously, as mentioned by Adam and Johnny, the information and the data set are so large that we need to think about a much more efficient, a much more ESG access for ourselves as investors, but also for our client. I mean, you know, long gone, obviously, the paper report, but the transmission of information that we need to give our client is actually huge. And the carbon footprint itself of the sustainable solution is non-negligible when we are transporting that volume of information to every single client. And, you know, for the largest, obviously, pension plan, it might be to every single pensioners in that framework. So I think there's something to be done in terms of technology itself, not only from a license perspective, but also how do we access and how do we store all this information to create copy of each other's information. Every single asset manager will have a copy of all the credentials of all the company in every single indices and beyond. So the technological revolution need to come not only of gathering all the information, we need to demonstrate that we're doing the right thing. Obviously, the planet equation is progressing, but also providing what we need to our client. But more importantly, I think at this stage for me is and storing it the right way.
Thank you. Thank you so much. I think that when we just think that we are getting somewhere, there's another issue come out: data privacy, you know, the pricing of the data, storage, and everything. So it's actually becoming even more complicated. But we are now open for live questions. I just saw some great questions from the audience. So, and they're quite challenging. So I'm going to think about who I'm going to give, and then we'll take it from there. But are there any live questions right now in the room? Comments, observations? Please, the lady here.
Hi, it was quite interesting conversation here, especially taking into account that ESG is quite hot topic on the market. And I would like to ask you a question: how you cope with the differentiation of regulatory requirements across the world? So we know that in Asia, it's quite strict regulatory requirements already in place. Here in the EU, we have more what we call guidance or expectations. In NAM, we also have some sort of expectations. So being a global organization, so how you tackle with this problem to set up unique rules for entire firm?
Yeah, so fortunately or not fortunately, we are based in the EU, so we're not bound by anything there, but we are bound by, you know, PRA, MAS, CBRC, SEC, etc. I think when it comes to ESG, climate-related regulation, out of all those that are applicable to us, actually the MAS is probably the higher standard because it does cover, like I say, the environmental risk, which captures climate change as well. So we focused on delivering on those requirements because they are quite similar to the PRA in the categories that they follow. So governance, risk management, disclosure, scenario analysis, etc. So that was useful that we could take those same pillars, and then basically we mapped the two together to see where the main differences were, but focused on delivering the program as an environmental risk program and defining climate change as a subset of environmental risk. So we looked at what was the broader standard. Now, if we had something in the EU, I would have said probably that would have been the standard we would have looked at, because again, it does cover that broader climate environmental risk. Now, I think with the PRA, because they were first movers, they just focused on climate change, but they will probably come back later with environmental or nature-based risk. I think that's definitely, from what I've heard, is going to happen. So I think we're in a reasonable position to adopt that because we've already taken that higher standard. So I think it's about looking across all your different regulators, seeing what the more complex standard is, or what delivers on the more broader standard, and then following that and then mapping the others into it.
Thank you. Can we take another question, please, before I... thank you.
Hi, guys. One of you mentioned greenwashing, and I just wondered if you could elaborate a little bit on the challenges that that brings for firms and investors ultimately, and what we can do to protect ourselves, if possible.
Maybe I can kick off because I do want to share a little bit, and then I have my guest. Because this is a very interesting topic. When we did our preparation call, we basically said, look, at the moment in the markets, the new hottest trend is called transition finance. Basically, they recognize there are sectors and countries that need to be supported, in order to have a global net zero. The existing green agenda, which often covers renewables, wind, solar, and waste management, etc., that need to continue. That's a scaling up thing. But if we only rely on this, we're not going to have a global net zero. So in other words, the divestment has made huge progress in terms of signaling and others. But working away from a problem will not solve the problem. Of course, let's be clear, not everybody will have a credible transition plan, including corporates and countries and financial institutions. We don't actually want those. We want the ones that are genuine, wanting to change and wanting to, make the effort towards a global net zero. So this is very much happening right now. It's called the transition finance and investment. In fact, the G20 last year, when Indonesia chaired this, has been the first time that we look at this topic holistically. So, sorry, I felt like I'm a panelist myself. Sorry, please, Johnny.
Yeah, I don't know how companies can issue two types of securities, and one which is generic business as usual, and one is a green bond. Last time I looked, cash is fungible unless you stick them in separate vehicles. So the first thing is all green bonds, and you just use bonds as the representative sample of a green product, but most green bonds are issued with a use of proceeds. Use of proceeds is highly subjective and is open to audit. Unless you ring fence that and you've got a very specific use. Then you've got sustainability-linked bonds, which are ostensibly key performance indicators, which will trigger an increase or a decrease in the coupon. Today, that increase and decrease of the coupon bears no resemblance to the amount of emissions, so there's no quantification of it. And then the third point I'd say about these green securities is they represent a few trillion. Well, the global bond market is about 450 trillion, and within that, it's dominated by government bonds. So actually, if you really want to know, how to price a security, it's no use pricing it off a government bond, which isn't green, and then a spread which is green. So mathematically, none of this makes sense. However, marketing-wise, it made enormous sense. But how on earth are you going to satisfy the demand when you're only issuing a couple of trillion in a market in the hundreds of trillions? It's an impossibility. So my view is the best thing to do is to actually look at the stock of instruments out there and figure out if they have the green credentials. Now, you could find there are 100 billion of assets out there, or 100 trillion, that are actually got better credentials than the so-called green bonds. But no one's done the work because no one's got a risk framework and no one's got a valuation framework for it. But I think that's going to be the greatest discovery, that we are never going to change through the issuance of new green securities, the existing stock of securities. And therefore, we've got to do the analysis on the existing stock of securities.
Thank you. Conscious that some of you might be hungry, so I'm going to draw a close. But I understand there are two questions coming on the pad, which we are grateful. One is about, are we in the place which we need under regulation or over regulation? Do we need more regulation? That's just one part. The other one is the question came up was putting politics on one side. Where does ESG regulation going to be for the US region? So I want each one of you to do a summary, but some of you, if you have points on these two, please share. But we're going to start with the ladies, that's okay. So Lucette, please.
Yeah, I don't think the regulation is necessarily what will conclude the whole means and hems and stop greenwashing and so on. I think asset managers, bank, client themselves, pensioners, which are obviously yourself, myself, and everybody in this room, have a huge role to play. And we can't be complacent anymore just adopting a default solution. So I would say, obviously, it's something that quite close to my heart, working for Fidelity, but I think in general, you know, everybody that come in your family, whether they're already receiving a pension or contributing to a pension plan, are one of the basic players in sustainability going forward. And I think everybody has a role to play. Coming back from India only a couple of weeks ago, where the next G20 will be held, we had this slogan all over the country on billboard. Maybe not the most sustainable marketing support, but you know, it's one world, one family, one future, and I think that's resonate and should resonate with any of us. So we need to act now, and I think we need to act fast through what we control individually, as well as we control, obviously, as a panel and as an industry.
Thank you, well said. Final comment from you, please.
Of course, and I'll try and close. Too much regulation, not enough. I think what you'll see is that even from the EU Commission, they realize that they've done a lot of work. So I think it's going to be a time of digesting the regulation that's already come on board. And it will be, I think, up to us as market participants to start looking at how we can take advantage, interpret all these regulations, and really come up with something positive and productive.
Perfect. Maybe 10 seconds on each, and start from you, madam.
Yeah, I think you do need regulation to drive action by banks, but in particular, I don't think a lot of firms would do anything if they weren't forced to. So I do. There is a balancing between being too much and too little. I think I agree with Michelle. It is a point to reflect now and see where things are. And the US question was, how does that going to evolve? I think, who knows? I think a lot of it depends. It's the most polarizing topic out there.
Let's make sure they pay their.
Yeah, in the US, and it's very much on party political lines. Yeah, I think the next election will be interesting as to where it goes. Yeah.
Thank you, Johnny, please.
Number one, if you're going to do anything in regulatory reporting, monetize it. You can't control regulation; it's going to hit you, but you can control whether or not you can make money out of the data and processes you have to adopt. And secondly, on the US. Just don't use climate and ESG. Use physical risk as a term if you want to talk to them. We talk to Texas, the least ESG and climate state in the world, and yet they are suffering from major physical risk issues. So just change the language.
I just first want to say that thank you so much for staying. And I think your interest and support for summits like this is incredibly important. And I also want to thank my panelists for being so honest and true in terms of their journey and where we're going. But if I may just very quickly summarize that we don't know all the answers. We can only learn by doing things. And I think Adam's point on balancing is very important. We can use it to think about, the outcome and the solutions. Whether we want this for real or do we just want this because it sounds good. I think we need to absolutely move on from that. And the other thing is, if people think that we need perfect data in order to make the right financing and investment decisions and to do disclosure, forget it. We live in an imperfect data. And this is where judgment comes in. This is where technologies need to help us making judgment. And our judgment, as Johnny said, and Lucette and Michelle, is to add value for the firms and ultimately for our shareholders and our community. Some people are doing very well. They're trying to do all the right outcomes. But that should be the outcome rather than doing it for the sake of it. So I hope all of us find the last 45 minutes useful, and we hope to learn more from you soon. Thank you.